Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Joe Furnari. How you doing today, Joe?
Good. How you doing, Kirk?
Good. Glad to have you joining us. Let's just dive right in because we were with Joe. We had an interesting topic here. This doesn't come up all that much, but it's something that I find is very important for the people who are looking to go down the path of technical analysis. So Joe, maybe you could tell us a bit about your background and how you got started.
Absolutely. Uh, So I got my MBA in finance and have been investing since the mid 1990s. I'm also an engineer by trade and an avid data enthusiast. One of the things that I did early in my investing career was apply fundamental analysis. It's a thing most people learn in the area of finance and investing. And I applied it to a T. I did a lot of customized research over the years, kept up with my publications like Wall Street Journal, Investors Business Daily, read investors books. I did pretty much everything by the book. And while that led me to a high performing stock portfolio uh, and to identify some good opportunities along the way, I still found myself making a lot of common investor mistakes that lead to poor performance. And some examples of that would be buying a stock and then watching it tank. Maybe you hit a home run and you see the stock double or triple right away, and you think you're going to retire in 2 years. So you hang on, and then the stock corrects 70%, and you kick yourself. You think, uh, why didn't I sell? It was those types of frustrations that led me, what about technical analysis? And that's kind of what got me started, Kirk.
Nice. Well, I appreciate that from a data geek being myself being one of them. Or you called it a data enthusiast. I have to give you credit for that. I'm going to start using that. That's a good turn of phrase rather than data geek. I'm an enthusiast. Um, well, cool. So that's great. So it sounds like you've made a lot of similar mistakes, and then so how did you get? I mean, fundamental analysis. I mean, there's definitely different schools of thinking around investing. I mean, there's the fundamental people, there's technical people, and there's momentum. There's all these different things. So why do you feel like technical is better than the other methodologies?
I wouldn't say that I feel that it's better. However, I think it's another tool in the bin that is a very valuable supplement to fundamental analysis. Fundamental analysis, there's a lot of key things like liquidity, the strength of cash flows that a company generates, its revenue growth, the industry trends, regulations, risks that are involved in some of the bigger trends that impact industries and stocks. And it is good to be aware of those. I still would encourage keeping up with publications and being aware of what's going on. But that by itself, what I've learned is doesn't automatically guarantee you good investing performance. I've learned that one of the thoughts that I had on technical analysis is there any trends or patterns or something about the stock price uh, that can be looked at and has a recipe for what's going to happen in the next 3 to 6 months? And those kind of thoughts led me down a path where I wanted to start doing some analysis, and I started looking at stocks from a 51-year period from 1970 through 2021. I took stocks of many different industries, and I started charting them out. And some of the things I've looked at relative to my recipe or the what I've come to learn as far as patterns that predict is the closing stock price, the 10-day moving average, and that would be the closing simple moving average is what I use. And the 200-day closing simple moving average. There's a relationship there between those three elements that have a high correlation to predicting good or bad performance in the next 3 to 6 months.
Nice. So why only those methodologies? Because I mean, I've met some technical people, and there's been a ton on the show, and everyone's got different methodologies, but that just seems very more straightforward. So why only those? Why not the crazy oscillators and there's 50 million. I mean, I look at my system here, and there's like 50 million different technical analyses. So why did you settle on those?
I wanted something simple. And again, I started this project just exploring, but I wanted something simple that would be easy to use. And I hear what you're saying on the other technical analysis models, and I've tried to learn some of those models. I'll be honest, I had a hard time following how to use and having the confidence to use it successfully. And I'm not gonna this was a long endeavor. I started in 2016, and I will tell you that after the first few years, I was banging my head against the wall. I did not think I was going to be able to find any patterns that predict. Then late one night, I had an epiphany. I thought to myself, wow, engineers tend to use calculus to find out relationships between variables. And we also use a tool called design of experiment to look at a combination of variables and how that combination can predict a set of outcomes. So with the model itself, I know I bring out those three elements, the stock price, the 10-day and the 200-day moving average, but there's a lot more to it than that, like which direction each is heading, what's the pattern. Some of the things I've noticed, just to give some examples of what I've found to predict, if you see a 10-day forming a multiple sine waves, and the peak of those sine waves is declining, and you have two or more declining sine waves in a 3-month period, that is usually a signal to not buy and a signal of poor performance ahead. So it's not just those three things by themselves. There's a lot of things as far as the direction. Another example is if you own a stock and it's performed very well, and you see the 10-day start to decline, the angle of decline is very important. If that decline starts to, if you were to draw a vertical line, if that starts to decline less than 25 degrees from a vertical, that's a sign to get out of that stock, that there's going to be troubled times ahead. And then I guess I would say, looking at those metrics, there's a lot of things like that that go into this particular model. But I was looking for something, not a day trading system. I wanted a system that could predict patterns and enable the person with a day job to keep their day job and chart stocks once a week, and then some selected stocks daily after market close.
Okay. So, one thing I've also noticed with technical analysis, I mean, certainly, the fundamental people have, I guess there's the growth and there's the value people, but the technical analysis people tend to not be necessarily bullish or bearish. But do you have like a bias, a bullish or bearish bias, or how do you kind of discern um, the pathway? Do you like short, or like how does that work in your methodology?
So good question, Kirk. Uh, as far as the methodology that I developed, it is about owning equities, buying and selling. And as far as the equity risk or market timing element, bullish, bearish, I actually developed two models. So one is a stock investment model that will help screen for the best stock opportunities available at any given time, when to buy and when to sell. The other model is what I call a market timing model. And that's also based on patterns that predict, but because and this is based on the S&P 500 equity index, I found studying that for also a 51-year period, I found that there are a lot of patterns that predict when it comes to timing the market or having the equity risk factor into play, even when investing in stocks. And an example of the market timing model is there's an element that I've observed, and it's very common with other significant downturns of the market index itself. One of those examples is I'm sure most of us, or maybe some of us, read in history books, but October 19th, 1987, Black Monday, where the S&P 500 had a fall of 28%. On that particular day, if you were to back up, I found a pattern that on September 6th said to move from 100% S&P 500 equity index into 100% cash. And then the key is when you get out of the market, you need to make sure you have good predictive patterns to not get back in before that fallout date on October 20th. In this particular case, the patterns that I found did not get you back into the market until November 1st. That timing model is more of a simple timing model. I've seen others where it's having you constantly change between equity index and cash. In this particular model, it will keep you mostly in the equity index, but pull you out at certain key times.
Okay. So the so when you're doing back testing, and maybe you can kind of talk a little bit about what back testing is for listeners who haven't heard that first.
So back testing is essentially going back in time uh, with a formulated set of logic of how you're going to invest, and then testing that model, just looking at each window of time. So in this particular case, I did a back test from 2007 through 2020. And the test that I set up for the stock investment model was I wanted to develop a model that would screen for the best stocks. So in this particular case, I took 500 to 750 stocks for each calendar year. And I kept really good records over the years of stocks that I've learned about, stocks that I've invested in, even throughout those early years. I had a pretty good awareness of what information was out there and what were good opportunities. And I took, all those opportunities for each calendar year, and I would go through and have the model reject certain stocks. And actually, all this data I do make it available on my website. But basically, it rejects certain stocks because they're not meeting the buy requirements of the model. And then for the stocks that it selects, which this particular model, after several iterations, picks the top 15%. It doesn't have to be a top 15%. It can be, that can float a little bit, but basically picks the top stocks that are screened through the model, and then we'll advise when to buy and when to sell those stocks. So using the model logic for each of the buy and the sell, I went through and the back test would simulate, okay, buying, here's where the buy requirement was met, here's the price that it bought and the date that it bought. And then that the model would hold that stock sometimes for a couple of years, other times in a very short amount of time. The length of holding the model doesn't distinguish between those. It just looks at whether it's predicted good performance ahead or bad performance ahead. Some stocks are kept for 3 years, but nonetheless, for each year, I simulated based on an assumed portfolio size and what the model would do. In some years, like 2008, relative to the cash or the equity risk that you had mentioned, bullish or bearish. 2008, which was one of the years in the 07 to 20 simulation test, the model held an average of 10% cash. In fact, it held cash from September 2008 through February 2009. In that regard, the model will advise when it's a good time to buy in stocks, And if there's no stock opportunities, it will keep you in cash. And actually, uh, I would say it's a development that builds on a lot of the frustrations that I've had over the years.
So how do you protect yourself from things like curve fitting and, looking at the back test and just saying, oh, well, this is the best path when obviously the future doesn't always reflect the past?
Yeah, in this case, it's for what it's worth. It's a technical analysis model. I wouldn't say it's the tool. There's a lot of great tools out there, but I think it's a great tool to have in the toolbox in conjunction with other things.
Right, but my question is how do you prevent yourself from getting caught into the trap of looking at history and just saying, "Oh, we're going to do it this way," as opposed to, well, we don't know the future, right? So you look at the past and you say, "Oh, well, the past it did this, so this is the best methodology," when in essence it might not be, right? There might be something better. So how do you protect yourself from it's more of a mindset thing of getting caught into that?
From my sense, you're right. I kind of use those models and I use them for all of my investing. But as far as not getting caught into other indicators, I guess really I from the model itself, the patterns that predict, the way I look at it is they did predict for a 50-year period. I do believe that's going to continue to predict. I don't know for sure. Obviously, it goes without saying, past returns don't guarantee future results. But one of the things when I was looking for patterns that predict is I wanted to see do those patterns predict in good market times or in bad? Are they consistent? And one of the things I found in the 50-year period is those patterns predict over the long term. And one of the other things that I found is on those patterns that predict relative to the stock model is they predict regardless of which industry the stock is in, regardless of market cap. I've seen it predict consistently between micro, small, mid, and large cap stocks, as well as growth blend or value stack. So as far as how do I keep myself from using other indicators or knowing what's going to happen in the future? I definitely don't know what's going to happen in the future. I just know that the model was developed from 50 years of analysis.
Okay. All right. That's fair. So what assets do you use when you trade? You mentioned individual stocks. Like what assets do you use when you're trading?
I do all individual stocks on all of my accounts except for my employer 401k, which is restricted to equity index funds. So in the case of the 401k, I use the market timing model to guide whether I'm in cash and short-term bonds or whether I'm 100% invested in equity.
Okay. Do you have any sort of screening you have for equities, which ones you will or will not use?
Yeah, so I have a simulated portfolio, and actually that can always be made available to the listeners for free. I can provide that. It's got all of the trades that the model executed for 2024, and to date, uh, this some of the stocks that are close to meeting a buy trigger. To give an example, go under the symbols of AEVA, AMPS, AUDC, CDNA, CROX, DOCN, GRIN, HBI, IHRT, OUST, and TDOC to give some examples.
Okay. Um, Now, have you, it sounds like you want to keep things simple. How long do you typically hold the trades? You mentioned you had some variability, but like, how do you determine the
So
holding period?
It's all based on buy and sell rules of the model logic. So, for instance, when a particular stock achieves a buy, if something happens, let's say an example of something that would happen that would cause me to sell, and it could be as short as just a few days. Uh, if the 200-day decline it starts to shift from an incline to a decline, because one of the requirements to complete a buy is that the 200-day is inclining, and I will only hold stocks as long as it is inclining. If the 200-day shifts to a decline, I sell the stock. uh, so the timing definitely is varies, but there's other stocks I've had for 2.5 years using the model. And to be honest, I developed this model from 2016 all the way through 2023. I was doing the final iterations. Some of the things that I would do to develop the model that I went through is when I finally started to find some patterns that would predict, I would do the back simulation back test from '07 to 2020, and I would record the results. And I still remember early in the model development when someone asks how does the back test compare to the S&P 500 index, and at the time the calendar years range from on average 50 to 100% better, and I was not satisfied with those results. I thought I wanted something that could earn better than that, and one of the things that went through my mind is if I could make the model, or if I could find patterns that could predict and get you into buying and selling very profitably in tricky years like 2015 or 2018, where the S&P 500 only grew 1.1% and negative 4.4%, or whatever those values were. But if you can get something that predicts in tricky times like that for buying and selling, then it's likely that the performance would be good. So I did a lot of data experiments within that 14-year simulation to improve the model and optimize it. Some of those things that I would do is I would take the worst performing trades and look at the buy point when the model predicted a buy point. And then I would see if any of those patterns existed on the best of the best trades, and basically honed in on what factors differentiate good stocks about to perform well versus stocks that are about to perform poorly. And as far as the timing of investment, it all comes down to when is the buy requirements met? And then what are the triggers, if there's any sell triggers that occur along the way? Now, for the most part, other than that 10-day decline example I mentioned earlier, for the most part, the process involves charting stocks once per week, and then the model will calculate a stop sell price that's all based on patterns that predict. And then you'll update that either once per week or as necessary, depending on what the output of the model is. So that kind of determines when the sell point is. It's all objective, predetermined buy and sell points. There's no, I made the model to where it's just relying on data to make a correlation on future performance. That's really what it's based on. So sometimes I own stocks for a week or less, and I would say the week or less is probably the very small sample size. But there's other stocks that go on for 2 or 3 years.
Okay. So what do you do for risk management? I mean, you mentioned stop losses, but how do you manage risk in this model?
So the model basically is looking for the technical analysis risk. So another example is if you see a stock explode, there's certain formulas where the multiple above, if it's a multiple above the 200-day line, there are different formulas that will help keep those gains in the event of that stock plummeting. But basically, the risk levels are all, I would say, the rules of selling comprehend the risk. Usually, when you see a stock behave in a certain way, technically, there's very high risk to keeping that stock and holding. And one of the things that this particular these predictive patterns do is even I would say it's even risky to have a stock that it's got a horizontal pattern for 2 years. All you're doing is collecting a dividend. You're there's actually a huge potential to earn more return on investment on your portfolio versus keeping stocks that stay within a horizontal trend.
Okay. Um, okay, cool. Well, we're going to wrap it up here in the interest of time, but what final thoughts from you? Where can people find more about you?
Oh, absolutely. I wrote a book, Ludicrous Returns versus the Market. I talk about both the stock investment model and the market timing model in the book. I also have training videos available on my website, ludicrousreturns.com. And if anyone has any questions on the model or the model development, I can be reached at Furnari at ludicrousreturns.com.
Great. Well, Joe, I really appreciate you coming to the show, sharing your experience and wisdom with us. And yeah, thanks again.
Thank you very much, Kirk, for having me. Really appreciate it.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Joseph. Really appreciate him coming to the show. Now we're into the panel portion of the show where we have our very own Barb Friedberg. Hey, Barb.
Hi, everyone. So happy to be here.
Glad to have you here once again. We also have our very own Doug Heagren. Hey, Doug.
Good morning, Barb and Kirk. Good to see, at least good morning where we are right now. Now, I'm not sure when you'll be listening to this, but good morning. And happy Q2, because right now we just moved into the second quarter, and we're so 25% of the year is down. So let's see where we're at right now. Let's talk about my life, money, and the pursuit of happiness.
Well, we'll talk about money. How about that?
Okay.
The others is a different show, but
well, if you start talking about the pursuit of happiness, you're going to you're in this day and age, you're going to ultimately make somebody unhappy. If you talk about your happiness, so you're right. We should probably avoid that this morning.
Yes, we're not going to talk about anybody else's happiness, just our own. All right, well, let's dive into it. So we talked about basically technical analysis, which is always a fun topic to get into. I try to bring it up every once in a while because people are always very territorial about their investing style and how theirs is the best and everybody else's doesn't make sense. So we're going to go to Barb first because I know Barb's got a very strong opinion on this. So Barb, what were some of your thoughts about the technical analysis conversation?
Well, for those of you that don't quite get it, technical analysis is looking at charts and graphs and trying to predict where uh, stock prices are going to go based on different quote unquote technical metrics, be they a momentum of a stock moving up or down. And it is compared with something called fundamental investing. And these two types of investments are very popular among individual stock pickers. So this is not so much for those of you that just buy an index fund and go with it, but this is if you want to try and beat the market. So what are my thoughts? Just let me throw this out. It's just data research based on many studies. And that is over time, it is very hard to beat the returns of the market, which means your S&P 500 or your total stock market index. Those returns typically outperform the returns of active investing 60, 70 to 80% of the time. So I put that out there when you're picking a way to invest. You're already setting yourself up if you choose to be a stock picker for the chance that you may underperform the markets.
Yeah, no, we're gonna dive into the weeds here. I know everyone's got different opinions about the technical analysis. Doug, what are some of your thoughts?
Yeah. So the thing about going back to what Barb just said, it is hard to beat the market. And I think what we're talking about in that regards is more specifically than not is trading, right? It's hard to trade and beat the markets. Obviously there is exceptions to that rule in individuals out there that have had phenomenal success over the time of beating the markets. People, arguably Warren Buffett, obviously being one of the biggest names, other people out there that are in the investment and institutional space have had a tremendous success over the years in beating the markets. But here's the difference for the most part is they're not trading, they're buying, they're investing, they're in for the long run. And when you start getting into trying to invest and trade and beat the markets, you have to deal with timing. And of course, there's always that there's a long-standing saying in the industry that some of you out here may have heard, some of you may not, but it's, you don't need to time the markets once. You need to time the markets twice, right? Ultimately, you got to know. So let's say you get out, and here's a perfect example. October, the markets hit their low last year. A lot of people, a lot of bad news, a lot of bearish news. I mean, heck, Kirk, you and I were talking about a lot of the ominous news that was happening, and all of a sudden something triggered. And there is a lot of speculation as to why it triggered, and things went really positive. Now, should it have gone positive? That's debatable, right? There's still a lot of really ominous data out there. But there said all of a sudden it was a belief that everybody's just going to cut rates. That was one of the things leading into this year. The market's gone on a tear. There's a number of people out there that in order to avoid loss, were out of the markets, got hit their final point. Now, guess what? Now that they timed that, they've got to time again. Well, what do you do now? The market's up 25%. Do you time and get back in? Well, now you've missed that entire run up. Now do you get in high? Of course, sure, it could run further, but it also could be the peak of a further decline. It is so difficult to time the market and make those strategic decisions of when to enter and when to exit and what to buy and when, especially when you're dealing with like Barb said, the broad spectrum markets, unless you really have significant knowledge about what you're doing. And even in that regard, many of the brightest minds still often fail at it, which is why most of the active, mutual funds out there, especially in the total market index, S&P 500 space, they have, after you take costs and other types of factors, have often not beat in the market, as she was saying. So this is something, I mean, there's possibilities out there, but for the average person, you don't have the time nor knowledge to do this effectively.
Yeah, and I'm gonna take the other side of this because I don't want this to be all one-sided, but I think a lot of people, fundamental analysis is the main topic, and the rules of thumb are all based on fundamental analysis. Everything you learn in school, everything that's taught on most of the stuff that's taught in any sort of educational materials is all about fundamental analysis. Very little is taught about technical analysis. And I think the reality is you have, people talk about, well, Warren Buffett's the most successful investor of all time, and he's a fundamental analysis. Okay, great. But what about Bruce Kovner, Richard Dennis, Paul Tudor Jones, Michael Steinhardt, Ed Seykota, Marty Schwartz, Tom Baldwin, and of course you have Jim Simons, who is one of probably the most successful investors of all time. And I don't know if anybody really truly knows what he's doing, but it's definitely not fundamental analysis. So if you really think about it, there are just as many people successful on both sides, but we're all taught about fundamental analysis. Now, there's always this battle about which is better, technical or fundamental. And I think you could probably get people on both sides who will disagree with what is the best approach. However, if you really kind of break it down, the best approach is actually both. And it's not one or the other. It's not, well, this one's better than this one. This one's better than this one. It's like, okay, well, fundamental analysis is great, but there are people called deep value managers, and they invest in similar to like what Warren Buffett refers to as cigar butt stocks, which is how he learned and why he actually initially he invested this way and didn't have as much success until he kind of thought about things a little bit differently. But cigar butt stocks is basically deep value managers. Well, the problem with deep value managers, they can keep getting cheaper, right? It's like, yeah, they're great value for a reason. And so if you're thinking fundamentally, if you apply the fundamental and the technical, like it could be like, stocks in the doldrums for a long time. And you notice it's there and you wait until it breaks out. When you break out, hey, now it's got some momentum and now we want to invest in it because it's still cheap. That might be a better approach than just putting money into it because it's cheap and hoping that it goes up in some future 3 to 5 years from now. I think, a combination of both, in my opinion, is probably the better way, but it also means you have to learn two very different skill sets. And in some ways, they're almost contradicting each other. But I think it is important to think about the technical analysis because it's the interesting thing is it's a lot of looking at charts, which is effectively the same as looking at tea leaves. However, if enough people believe in it, it makes it true. So there's this concept called reflexivity that George Soros talks about in one of his books. I think Karl Popper was the one that actually came up with it. The philosopher Karl Popper came up with the concept of reflexivity, which is if you believe that we're going to have inflation, that will cause more inflation. If you believe we have deflation, that will cause more deflation. Because the way that inflation works is if you believe there's going to be inflation, what are you going to do? You're going to get rid of your money. You're going to invest it. You're going to take out debt, right? Because debt will eventually get inflated away. You leverage up your assets. It allows you to make more money. So ultimately, it causes more inflation. If you believe you have deflation, the best thing to do is to hold onto your cash. Stick it under the mattress. It's the best thing you could do. And so what happens? People hold on to their cash, which means they don't invest it, which causes more deflation, which induces people to hold on to more cash, which causes more deflation. So it's self-reinforcing. But the reflexivity is people believe something to happen, so it's going to happen. So bring it back to the point, technical analysis. The technical analysis is watching charts. If enough people believe that watching charts works, then it works. Because enough people will say, oh, we have a 200-day moving average. It's going to bounce off that. So what happens? People buy at the 200-day moving average, which bounces off the 200-day moving average. So it self-reinforces the behavior of it happening because you believe it's going to happen, and enough people believe it. So while it may have started as kind of just this study of psychology of people, it's ended up being people believe it to be true because it's true. The U.S. dollar, people believe it has a value, so it has a value. It's just a piece of paper, but people believe it has value, right? And crypto, people believe it has value, so it has value. It doesn't actually have value, but people believe it, so it makes it true. So all of our economy is based on this belief of something having a value. So I think you can't discount the technical analysis part because in essence, it has a value because people believe it, which is how the stock market works in many ways as well. So Barb, what are your thoughts about that? I mean, I know you're more of a fundamental gal, but what are your thoughts?
I am a fundamental gal. For those of you who need a little more primer on what is fundamental, it means looking at the actual company, looking at their revenue, looking at their earnings, looking at the growth rate, looking at what kind of products they're introducing into the market, so that what are the things that will propel the company going forward. That's what and then deciding to purchase or not, depending on whether the upward potential in price merits the current price that the stock is available at today. So, in my opinion, you're treating a company with fundamental analysis as if it is an entity for growth, and that growth creates price appreciation, which creates you money. Technical analysis doesn't consider what the company does, or what its profits are, or anything about the company other than how it is moving. And so, fundamentally, not to be funny, it just doesn't make sense to me. And on the other hand, again, with respect to your comments, Kirk, about, well, you can use a little bit of technical analysis. And look, I'm not saying you just stay invested forever through thick and thin. Personally, when stocks are really, really frothy, in other words, they're valued very highly according to their historical averages, I'm hesitant to put more money in. And I may wait for a pullback to put a little more money in. And that's, in essence, market timing. But here is another story that you may not be aware of, which is in support of buy and hold. Compare two investors over, say, 20, 30 years. One investor stays invested through thick and thin, ups and downs in the total market. And at the end, they get an average 10% annual return. The other investor thinks that he is or she is smarter, trades in and out, and is very unlucky, and misses the 5 greatest advancing days, the 5 days in that 10-year period where stocks advance. The return, that's it. They only miss 5 days. They traded out on those 5 days. Their returns are significantly lower than that 10%. I don't have the exact percentage lower, but it was in the range of, 30, 40% lower. So what does that tell you? It is so hard to time the market. And if you wait for it to rebound, maybe it makes its biggest jump initially. And if you haven't been in the market, you're missing that advance. Just like in Doug's example.
Yeah, I think what's interesting is if you kind of bring it down to brass tacks, fundamental analysis is still market timing to some degree. The differences with technical analysis is, depending on your style, because every style is different, there's more transactions. So both of them, you have an in and an out. So there is market timing somewhat, right? It could be the wrong timing in, whatever. So fundamental still has the same problem. There are typically just fewer transactions to make mistakes in with fundamental versus technical, which is typically there are more. I do want to bring up some topics, but there's a handful of things that come up when it comes to technical, which is timing the markets, which we talked about, back testing and curve fitting. So I do want to mention this and want to hand it over to Doug for his thoughts, but typically you see a lot of people selling some great scheme or system that they got. I got this system, made me 90% in 2 days, and they're trying to sell it to everybody. And the reality is what most of those people do is they do what they call curve fitting, or they use back testing. Everybody back tests. It's actually an important part of it, which is you got a thesis. You think, all right, I think this system will work. And by the way, anyone who's pursuing technical analysis, if you're not doing this, then you're basically guessing. So some of the best people, if you look at, somebody like Paul Tudor Jones, who has, I think he's got like 6 or 7 different systems, and he turns some on. If they stop working, he turns that one off and turns on different ones. So he's got these different systems that are always working based on market conditions. And what's interesting to me is, if anyone's doing this, you should be back testing your system. You come up with a system, a thesis. I think if the 50 days above the 200 day, I'm going to go along. Let's back test this. What does that look like? You back test the data, and there's plenty of things to back test data nowadays, by the way. You back test it, see how it did. What was the performance? Okay, well, that's not as good as I would have liked. What if I tweak this? What if I tweak this? What if I tweak this? And people start tweaking it and back test, and it's like, oh, look at this. I found 90% returns a year using this back test model. Well, what's the problem with that? The problem is that it's back tested. It's not forward tested. It doesn't predict the future. It just predicts that, hey, if you look at things hard enough, you can find a system that will give you 90% returns over history. You know what? I could find a system that would give me 10,000% returns a day in history if I looked hard enough. But that doesn't mean it's going to work in the future, right? So understand that the backtesting strategy is you're using it to test out your thesis, to see if your thesis makes sense, to see if it's on par. Now, it doesn't mean it's going to work in the future, but it means that it has some validity to look into it further. Now, the problem is what people tend to do is we call curve fitting. Now, curve fitting is when you find a set of data and you design your system around this data. So what a lot of people do, and there's a firm that got caught for this, and I won't mention them because I don't know where the lines are of getting sued, even though the firm's not around anymore. But basically, this firm, what they were doing was curve fitting. So what they would do is they would come up with they had these systems. They had like 10 different systems. And the systems, what they did is they would show the performance of the system for like the last few years or whatever. It's like, wow, look at all this great performance. And magically, it was like 10 to 15% a year all the time. And so what we found out they were doing by the way of the SEC catching them in this is they were doing this. And funny thing is, if they had disclosed this would have been okay. But because they didn't disclose it, that's where they got in trouble. But what they were doing is basically back testing these systems. So every month they would back test it and say, all right, this month's April's system is going to be this. And they would look back and back test it. So it came out to be 10%. Wow, it's 10%. It wasn't actually 10%. They were showing you the back test. They weren't showing you the actual returns. So people complain. They're like, why am I not getting 10%? I only got 2. Well, it's because it was back tested. So what they're doing was curve fitting, which is they saw data points and they said, all right, how can we make 10% work? And they came up with a system that aligned with that 10%. And so the curve fitting was a system designed around the data points to meet a certain outcome. That's a problem. And that's where people get into trouble. They sell these systems that are great. It's not actual results. It's just back-tested systems that are curve fitted around certain data points. So that's the thing you got to be careful of when you're looking at technical analysis, is because people will frequently show you the best things and they will hide the bad things, or worse yet, they'll show you some data that wasn't applied in reality, more theoretically, and saying, oh, if you had done this, you would have done that. So Doug, what are some of your thoughts on all this? I mean, you see this from time to time.
Well, first of all, yes, I didn't get a chance to address it before. I think really the big difference between fundamental and technical is fundamental is generally going to be long-term thinking. So it's like, this is a good quality thing to invest in, right? Now, obviously, the data changes. It's no longer a good thing to hold. I mean, even Warren Buffett eventually sells somebody, right? Technical investing is very short-term. It is looking at trends in the market, looking at whether or not it's going to break through and continue a certain way, whether that's positive or negative. And I think it's a lot of guesswork too. It's like, well, if it hits this and it bounces off it a couple times, and that's a bearish signal, but if it breaks through, it's a positive thing. There's all this stuff, and you've got to have experience in it. What I really want to get back into, though, is I want to go back to the timing of the market argument and staying fully invested. So there is a white paper that was put out. I believe this was done by JP Morgan using data from Bloomberg. But going back to this is between, let's see, I believe this is looking between 2000 and 2020. So January 3rd, 2000 to April 19th, 2020. So being fully invested in the market, never being out of the market during that period of time, was a 6.06% rate of return. Okay. Now, had you missed those 10 best days, it would drop to 2.44%. Missed the 20 best days, it's 0.06%, and then it continues down there. Once you get to 30, you're negative. Okay. So, but here's the really interesting thing that they came up with the data. Okay. Is that as of the year 2019, 6 of the best days occurred within 2 weeks of the worst days. But often the spread is much closer than that. So through April 2020, there was 7. There was 7, with 5 of those best days occurring within just 1 week of the worst day. So, for example, March 2020, the second worst day in 20 years happened on March 12th. The 4th best day in 20 years happened the next day on the 13th. The next worst day in 20 years, the actual worst day in 20 years, occurred the following Monday on the 16th. Okay, it was down 11.90%. You get to August 2015, the worst day of the year was on the 24th of August. The best day of the year was on the 26th of August. December 2018, the 6th worst day of the year was on the 24th of December. The best day of the year was the 26th. Okay, so 6 of the 7 best days occurred after the worst day. 7 of the 10 worst days were followed the next day by either top 10 returns over 20 years or top 10 returns for their respective years. The issue really happens is that people are more risk averse than risk tolerant, right? So what happens is there is generally signals to get out of the market, okay, because it gets painful. There's no signal to get back in. That's the problem, okay? So in order to really make it effective, so I want to do the counterpoint here, okay? So a performance of $10,000 investment between January 3rd, 2000 and December 31st, 2019, the rate of return threshold to sell and miss the next day trading, okay? If you're fully invested, you lost 8%, then you lost 7%, then 6%, 5%, all of this having to do with 4-day periods, okay? And what happened is, again, people, it's easy to get that trigger to get out. Very difficult to get back in. There's no signal to get back in. So basically, the main thing here is that investors would generally need to buy in on the worst days during some of the most significant market drawdowns when loss aversion is at its greatest. Now, counterpoint, if you can do that, if let's say you were perfect and had a great crystal ball, if you could, again, we said 6.06% is fully invested the entire time. But what if you were so magically astute that you could miss the 10 worst days? You immediately jump to 10%. The worst 20 days, you jump to 12.89. The 30 worst days, 15%. So is there value of timing and getting out and missing the worst days? Everybody likes to talk about missing the best days and the impact of that, but there's truly impact of missing the worst days too. The problem with that is that the worst and best days often cluster together, and that has been very, historically very true. And it's again, one of the analogies they use is like rain and rainbows. Generally, a rainbow appears only after a thunderstorm. Yes, you may want to miss the rain, but you're likely to miss the rainbow that follows right after that too, because you went down into the bunker. So based on that, again, I do think that losses compound more than gains overall, and the math here shows that. However, it's extremely difficult to do it by buying into the market and buying out of the market. If you're going to do technical analysis, you've got to watch an immense amount of data, because one data could tell you one thing, another piece of data could tell you the other. As I said in the beginning of this, extremely difficult for the average person who's working a job, raising kids, living at home, trying to do this, to be able to do that at a level in which they're going to be able to watch all the data and be able to make a decision with at least as much of the cards as they can. And because these worst and best days occur so close to each other, again, not telling you to do it, but there's probably a lot of times a timing component right around when you think it's the worst one way, it may soon be the best the other way. Not always the case, which is why it is so incredibly difficult. What's okay? Let's say it's the next day. What if it's a week later? What if it's a month later? It's still so close that it leaves way too much risk in order for you, especially when the reason to get out in the first place was emotionally driven in most cases. By the time you're emotionally driven to get back in, that is regret, and that is not a good investment strategy.
Yeah, I think that's great context, Doug. I appreciate you kind of sharing that, because I think most people, they hear one part of it and they don't see the whole picture. They just see, oh, missing the worst days, and it's not really the whole picture. Barb, what are some of your kind of follow-up thoughts on that?
Well, I appreciate Doug kind of went back and made my point with the actual numbers. So, I really don't have any follow-up thoughts, but I'll spring back to your other question about back testing because we all love to look at history, because in reality, as far as I know, there is no perfect crystal ball. Nobody knows what the future holds. So what do we have to work with? We have history. And I love to look at historical returns. I've looked at them from 1923 to 2023. I've looked at them from 2000 to 2023. I've looked at the last 50-year returns, all in an effort to make sense of what kind of asset allocation do I have? What is the likelihood of my returns during the future? I like to look at the volatility. Now, and there's also another concept called reversion to the mean, which is if you look at the mean stock market average, let's just ballpark it at 10. Well, this past 12 months, we've had 30% return in the S&P or the total stock market. Can't remember which. Now, what is that telling you? Are we going to get 30% next year? We might. Highly unlikely. So there is a concept called reversion to the mean, which is over long periods of time, your average returns will go back to what is a mean return. But we're talking long periods of time, not 5-10 years, but many, many years. So how can we use that to predict our returns going forward? I think we can assume that during the next few years, we're going to have a little bit of a reversal and returns are going to be lower. But when is that going to happen? Does anyone know? No, we do not know. And that is why, just with money that you want invested in the markets for the long term, which means for your retirement, for goals, 7, 8, 9, 10 years ago, to in the form going forward, just leave it invested. Okay? Because even if we get lower returns in the stock market going forward for the next few years, it's still likely going to be higher than those returns in cash. And if you want to look at the charts and figure out when the lower returns come and say, okay, I'm going to get out then, some people can do that. I'm not going to say it's impossible. But as we've said throughout this entire conversation, knowing when to get back in is key. And my guess is the people who do that successfully most of the time, they're not talking about it. They're not publicizing it. I'm sure there are people that are very successful technical investors, but they're few and far between.
Yeah, no, I think it's just important to put everything in context, because I think people see these outrageous numbers and they get all excited, and these are people who want action. And I think people have to realize they have to understand their own investor psychology, right? There are people that do well in that environment, and they need that. They need the action. They do well in this fast-paced, moving environment. There are other people that are really more calculated, and they're very systems oriented, and they're non-emotional, and those people can do very well in that environment. But for the most of us who are just trying to do this on the weekend, or you're reading an article and you want to buy this stock, and that's the most research you've ever done, that's not a good idea, right? I'm just going to be frank. If you haven't studied technical analysis, don't do it. If you haven't studied fundamental analysis, don't do it, right? Find a system that aligns with your psychology as well as the time you can put in. That's why so many people are indexers, because they have no interest, no time, no background for the markets. And that's why indexing makes sense. That's why Warren Buffett says, hey, people should index, because it's hard to go wrong when you're indexing because it's the whole market. Whereas if you're trying to beat the market, you have to really be an expert, because people are spending billions of dollars a year in research and studying to figure out how they can beat the market. And yet, what's that done for them? Well, some people like Jim Simons make 70% returns a year for like decades. Probably the best performing person we know of. And all this stuff's secret. He doesn't explain what he's doing, obviously, but it's very secretive. But here's a guy who's really smart, really good at math, and has come up with some systems that worked. And there are people out there like that. But those people are not us. I'm not that person. I don't have that kind of money or background to do that myself. And frankly, nowadays it's a lot harder than it was when he was younger. Now there's computers and systems and AI and all this stuff's coming out, and it's going to make it increasingly harder. So, you have to find a system that works for you and aligns with your psychology. Because if you can't deal with the day-to-day up and downs, don't do it. If you're a Warren Buffett type, the anaconda investor, the wait for the easy prey to walk right into your grasp, great, then you should do that. Or Jim Rogers, who says, I just wait till there's a pile of money sitting on the floor and I go pick it up. That's a great strategy if you can do it, right? But unfortunately, it requires patience, right? Warren Buffett he's sitting on billions in cash right now to wait to invest. That's smart, but you're also giving up potential upside in the interim. So most people can't deal with that. They're like, oh, 5%, I don't want 5%. The market's up 30. Why am I not up 30? It's like, well, what if it crashes 60% the next year? They don't think about, well, I was thinking this last year. They just think about today. That's 99.9% of the investors, is they don't have a perspective on time. Everything is now. It's not the future. It's not the past. It's now. So you have to be able to control yourself, which is really hard for all of us. We're human beings. We all have a difficult time at this. So if you're going to do more transactions, it means you have to be more in control of your own psychology. So Doug, I know we're probably going to wrap it up here in a few minutes. What are some final thoughts from you?
Well, final thoughts. First of all, I'll just go back because we brought his name up a few times. Jim Simons, his 13F portfolio, there's people that track it. Interesting enough, as great as he's been since Q4 2020, guess what? His performance of his Renaissance technologies is actually just about the same annual performance as the S&P 500, at least during that period. So again, long-term, may have had some phenomenal success at times in which the rest of the general public didn't. But again, even as the talk about the billions and the smarts and the investment in that over the last 3 years, you're looking at, well, guess what? Index works. The other thing that I wanted to take, and for the average person, you're not going to have near the opportunity to buy the little things in it that might be working in order to create that success. The other thing I wanted to talk about, and this comes from Capital Group. I thought this was an interesting article that they put out, is, look, okay, sometimes you make the mistake. Sometimes you time it. Sometimes people get out in October and sit there going in January going, oh gosh, what did I do? Now the market's run. What do I do? Now it's too late to get back in. So Capital Group did a study that showed from 2003, or calculation from 2003 to 2022. And they took two different scenarios. It said, what if you had taken and invested $10,000 a year? And in scenario one, you took the $10,000 and you only invested it on the best day of on the worst day of the year. So catching the lows. Now, the scenario two, the second person, same thing, 10,000 a year starting in 2003. They decided to put that in, but they timed it poorly. They picked the absolute best day of the year to invest, the most expensive purchase. Interestingly enough, as you would expect, the person that bought on the worst day of the year outperformed the person that did it on the best of the year, but not as much as you would think. The cumulative average, or the average total return between March of 2003 to 12/31/2022 for picking the best day of the year 11.43%. The average return for picking the most expensive day of the year, 9.48%. Most people would feel pretty darn good about 9.48%, which means if you need to get in the markets, if you've been sitting on the side and now you're waiting for that second timing, the best timing is now, because guess what? You've got to get back in ultimately. Now, there's, again, other technical ways to look about that. If you want to get into that, that's up to you, or rely on a professional manager who can look at that stuff for you, and then sit back and just worry about the things you know the best. Do your job, raise your family, and don't worry about the markets, because at the end of the day, there's more to successful financial planning than just rates of return. But that's a conversation for a different day. Yes, one of the biggest expenses that people are going to run into is college planning. So I'm just going to put a little plug there. If you want to learn how to not fleece your retirement and actually pay for college in many more effective ways and save more for college, thinking outside the box and not just blindly putting your money into a 529, which isn't bad, but that doesn't tell you how to pay for college. And ultimately, it doesn't tell you how much that impact is on your retirement. Learn some information. Start by going to procollegeplanners.com, procollegeplanners.com. Learn more information right now. Thank you for having me, Kirk.
Great. Thanks for coming on, Doug. And Barb, final thoughts from you.
I think we all have heard that sticking in the market, using market matching index funds is a successful way to invest. And for most people, market matching returns is quite good. For those of you that have interest in trying trading, day trading, technical trading, stock picking, all those other types of activities, and you want to do it, and you want to spend some time doing that type of study and analysis, by all means, give it a try. My suggestion is, in order to protect your money for the long term, carve out a portion of your total investable assets. So if you have $100,000 of investable assets, choose 5% or $5,000. Do whatever you want with it. When you have those big losses, it's not going to kill you. And you can learn, you can practice, and then you can make your decision. Am I good enough at this that I want to deploy more capital, or is this more trouble than I want to take? So I use that 5% recommendation for any type of speculative investing, crypto, anything that is kind of more volatile. So I am Barbara Friedberg. You can find me online at Barbara Friedberg Personal Finance, on YouTube, on LinkedIn. See you later. Thanks for having me.
Great. Thanks for coming on, Barb. Thank you both for joining us. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.